The expectation is always just up. It's the nature of Bitcoin. But if you were watching the charts in the last 24 hours, you saw Bitcoin kind of oscillating right around that fragile $92,000 mark. It looks nervous. It looks like a market in retreat. And yet when you pull back from just the price screen and you look at the infrastructure that's being locked into place, I mean, the regulatory, the monetary structure, the long-term signals are just deafening. There's this huge divergence happening right now, and that's what we need to unpack. So our mission today is to cut through all that noise for you. We're going to deep dive into this trifecta of variables that are really defining this moment. We've got a fractured central bank decision, a massive regulatory unlocking for big banks, and a pretty scary spike in security risk, that is.
Yeah.
Oh, it's pretty ingenious.
It is a seminal moment. I mean, what we're seeing isn't just a standard dip. Analysts are calling it a sovereign-grade correction, and I think that's exactly right. The asset is being repriced based on hard realities, not just hype. It's shedding the weak hands, the tourists who piled in. It's necessary pain, but the foundation being built underneath is profound.
Okay, so let's start right there with the immediate catalyst, the FOMC meeting on December 10th. The headline was the rate cut everyone expected, but the market sold off. So the devil was in the details. Or maybe in the dissent.
Precisely. The nominal reduction was 25 basis points. So that brings the Fed funds rate target down to 3.5 to 3.75%. But here's where all the confusion came from. The vote. It was a really unusual 9-3 split. And when a committee is that divided, the message gets muddy.
And it wasn't just three people saying no, right? They were saying no for completely different, even opposite reasons.
Exactly. You had two regional bank presidents who actually voted for a pause. They're arguing that inflation is still too sticky, the labor market's too tight. That's your classic hawkish dissent. They think the cut was a mistake. But then, on the complete other side of the spectrum, you had Fed Governor Stephen Miran. He voted for a much more aggressive 50 basis point reduction. He's saying the economy is slowing down fast and the Fed is already late.
Okay, so for those of us who aren't on a fixed income trading floor, why should we care about a 9-3 split? Doesn't the outcome, the cut, matter more than the internal squabbling?
It absolutely doesn't, and that's because this infighting creates what we call policy fog. Historically, a unified Fed gives the market a clear roadmap for liquidity. But when you have hawks screaming halt and doves screaming go faster, you can't rely on that predictable Fed put anymore. That safety net is gone.
So it raises the bar for the next cut.
Much higher. They have to keep this fragile coalition together, so the threshold for cutting again in March just went way up.
And that explains the market reaction. The price sold off almost instantly, right? From around 93,000 down to test 90, it was a hawkish cut. What was the specific phrasing that triggered the sell-off?
It was the reintroduction of one specific phrase. The committee pledged to carefully assess incoming data. For trading algorithms, that's a classic signal that future easing is absolutely not a guarantee. It was read as a tightening of financial conditions compared to what everyone expected.
So for Bitcoin, which loves low real rates, this basically put a floor under how low they might go.
Exactly. The market realized, okay, we got the cut today, but we lost the guarantee the next one.
So the rate talk was hawkish. It injected fear. But at the same time, the Fed made this other quiet, almost secret move with its balance sheet that seems completely dovish. Let's talk about the return of bill purchases.
This is probably the most important detail that got lost in the headlines. The Fed announced it's restarting Treasury bill purchases. We're talking about $40 billion a month, starting December 12th.
$40 billion a month. That sounds a lot like QE, quantitative easing, but they are adamant it's not.
And, well, they're technically correct. That's why analysts are calling it QE-Lite. The distinction is really critical for you to understand. Standard QE is buying long-term bonds. The goal there is to push investors into risky assets, to inflate asset prices. QE-Lite only focuses on short-term assets, T-bills. The stated goal is just liquidity management. But the effect is anything but boring.
So how does that translate to Bitcoin? The Fed buying short-term government debt. How does that create crypto upside?
It's a direct mechanism. When the Fed buys those bills, it creates reserves to pay for them. It prints money. Those reserves flow straight into the banking system, increasing what we call net liquidity.
And Bitcoin is like a sponge for that liquidity.
A high beta sponge, exactly. When that pool of cash expands, some of it always chases high return assets. So this $40 billion injection is basically a covert support system for assets, and it offsets the ongoing quantitative tightening. It's hawkish talk, but with a huge dovish action behind it.
And that divergence is the whole story right now. They're saying one thing, but doing another. It seems like the market is already starting to call their bluff.
They absolutely are.
Mm.
Despite all that cautious language, futures traders are already pricing in almost a 40% chance of another cut in March. The market just doesn't believe the Fed can hold the line. This tension, their words versus their actions, is going to define the next quarter.
So if the Fed dictates the cost of money, then the regulators dictate the flow. And on that front, the landscape just shifted, decisively, in favor of mainstream adoption. This is a huge structural tailwind.
It is. We're talking about breakthrough guidance from the Office of the Comptroller of the Currency, the OCC. It's called Interpretive Letter, hashtag 1188, and it confirms that national banks can engage in what are called riskless principal, crypto asset transactions.
Okay, riskless principal. That is pure financial jargon. We have to break that down. Why is that specific term so powerful?
It all comes down to risk on the balance sheet. Under the old rules, if a bank like, say, JP Morgan wanted to buy and hold Bitcoin, that's a standard principal trade. That exposure comes with a catastrophic capital requirement, a 1,250% risk weight.
1,250%. What does that even mean in context?
While holding cash is a 0% risk weight. A corporate loan might be 100%. A 1,250% risk weight means the bank has to hold 12.5 times the capital just to cover that risk. It basically made offering spot crypto trading impossible for them.
So how does riskless principal get around that?
Because the bank never actually takes on the inventory risk. They instantly match a buy order from a client with a sell order. They're just a middleman. The buy and sell legs of the trade happen at the exact same time.
So they're just acting like a very sophisticated broker connecting two parties.
Exactly. And the OCC ruled that because the bank never holds the risk, not for a millisecond, the activity is functionally the same as traditional brokerage services. And that is permissible. This creates a compliant pathway for every major U.S. bank to offer spot Bitcoin trading in custody without those insane capital charges. This is the structural unlock the industry has been waiting years for.
And this administrative relief is getting reinforced elsewhere, too. It seems like the stars are aligning.
They are. On the legislative side, Senator Cynthia Lummis is getting ready to release a big crypto market structure bill, so the politicians are getting on board. And globally, capital is just moving to where the growth is. A16's Crypto, Andreessen Horowitz, just opened its first Asian office in Seoul, South Korea. That tells you that while the U.S. is finally laying its institutional rails, the really rapid growth in things like gaming and social Web3, that's pivoting to hyperactive markets like Korea.
Okay, let's shift gears from the structural pipes to the immediate trading picture. If institutions are lining up to buy, the short-term chart is, well, it's not reflecting that optimism. It looks tough.
It is a very rigorous technical test. Bitcoin is testing that huge psychological support at $90,000. But the most damaging thing that happened post-FOMC was the failure to close above $94,253.
Wait, okay, for someone who hasn't studied technicals, why is that specific number, $94,253, so important? What does failing there mean for market psychology?
That's the 61.8% Fibonacci retracement level. It's the most important test for any rally. When you fail there, it often means the entire rally that came before it was just a corrective bounce, a bear market rally, and not the start of a new, powerful move up. That failure gave the bears all the confirmation they needed.
And analysts are pointing to a bearish topping pattern now, suggesting more downside is coming.
Yeah, the shoulder-over-shoulder pattern. When you calculate the measured move for a breakdown from this pattern, the target aligns almost perfectly with the $85,000 to $86,000 region. And that zone is significant. It's where you have key structural support and another Fibonacci confluence zone. It's where big institutions are likely setting their buy orders.
And what are the other indicators telling us?
Well, if we check the Relative Strength Index, the RSI, it's hovering in the 40 to 45 range, not yet oversold. That usually happens below 30. This suggests there's still, fuel in the tank for the price to drop lower towards that $83,000, $85,000 support before we see a real capitulation.
But here's the divergence that brings it all together. The ETF flows. Leverage traders are selling, pushing the price down, but the long-term players are doing the exact opposite.
Absolutely. While the price was falling, the spot ETFs, Fidelity, Grayscale, they recorded over $250 million in net inflows. This tells a really powerful story. Leveraged futures traders are getting liquidated, but sophisticated long-term allocators see this as a buying opportunity. They're looking right past the noise to the regulatory and liquidity tailwinds we just talked about.
Okay, let's pivot sharply. We've talked money, regulation, charts, But there is a critical non-financial layer to this whole story. And honestly, operational security risk has just spiked dramatically. There's a new vulnerability that's being actively exploited.
This is a really high-severity threat. It's named React2 Shell, CVE 2025-55182. It's a remote code execution, an RCE flaw that affects React server components. And these components are used to build the front-end interfaces of, well, countless DeFi protocols, exchanges, wallets that you might be using every day.
And it has a CVSS score of 10.0. That's the highest possible severity rating, isn't it?
It is. It's a pre-authentication flaw. That means an attacker doesn't need your password or anything. They just need to load a malicious web page or send a specific request to gain control of the server that's hosting that interface. The risk is immediate.
And researchers are pointing the finger at North Korean state actors, Lazarus Group. They're using a new malware called Etherrat.
Yes, and their goal is pretty simple. Compromise the website you're on, alter the transaction you think you're signing, and then drain your wallet.
But the truly innovative and frankly terrifying part of this is how they're commanding the malware. They're calling it ether hiding. How are they using the blockchain as like an undetectable command structure?
This is next level stuff. It leverages the very idea of immutability against us. Normally, malware connects to a command and control server, a C2 server, at a specific IP address to get its instructions. Authorities can find that IP and shut it down. With ether hiding, the malware connects directly to the Ethereum blockchain itself. The attackers upload their commands like steal all funds disguised as tiny bits of data in a smart contract. The malware then just queries public gateways to the blockchain to retrieve its instructions from the immutable ledger.
So the commands are just permanently broadcast onto the internet. You can't take them down.
You can't. Because the commands live on the decentralized blockchain, there's no single server to seize or firewall. It makes their C2 structure incredibly resilient. It's a huge leap forward in state-sponsored hacking.
The practical takeaway here for you, the investor, has to be this. The institutional rails are being built, but the on-ramps, the access points, are under a very sophisticated attack. You have to be extremely cautious with any DeFi front end and religiously verify every single smart contract interaction on your hardware wallet before you sign anything. Just assume the website could be compromised.
So to bring it all together, the market is fleshing out the post-election tourists. It's a necessary sovereign-grade correction. You've got all this short-term pressure from the charts, from the Fed's cautious talk, and these very serious security threats. But all of that is battling against these powerful, long-term structural tailwinds. I mean, the OCC integration and that $40 billion a month in QE-Lite liquidity.
So here are the three key takeaways for you to focus on as you navigate all this. 1. That $94,253 resistance level. It is the absolute key. Until Bitcoin reclaims that level, the short-term trend is still pointing down. 2, the $83,000 to $85,000 zone. That is now the high probability accumulation targets where the technicals and the institutional value perception seem to align. And 3, the OCC's riskless principal letter. That is the single most important long-term structural unlock for traditional capital. It validates the entire asset class for Prime Brokerage services.
And that brings us right back to the core conflict, the fundamental tension that's going to define the next few months. It's the battle between the Fed's hawkish rhetoric, their words, and the inevitable debasement implied by their massive bill-buying program and their actions. The question we think about is, what's the more powerful force here, central bank words or central bank action? We'll leave you to mull that over.